Hi everyone, my name is Corey Stackhouse. I'm a virtual certified financial planner with Stack Enterprises. And in today's video, we're going to go on a journey together to determine where you should be investing your hardest earned money first. We're going to cover everything from emergency savings funds, paying down debts, employer-sponsored retirement plans, and even individual account types, including IRAs, Roth IRAs, health savings accounts, and more. At the end of the video, I'm going to give you a bonus tip, which is probably going to change your perspective on your own investment management and financial journey as well. Lastly, I am a financial professional. I do give investment advice to my clients. Please consider speaking with your financial professional, insurance agent, estate attorney, tax advisor, whomever it is that you manage these concepts with to see if it is applicable to you. In the event you are looking for a financial advisor or somebody to give you advice on these topics, here at Stack Enterprises, we are happy to help. Our contact information will be in the description below. After that, let's get on to the video. All right, the very first place that we should start should be setting up an emergency fund with your hard-earned money. An emergency fund is going to be there for any unforeseen expenses. It's also going to keep you from dipping into your investments in case you need money for something that you had not expected in the future. There is a target of, they say a single individual, depending on who you talk to, thinks that you should save anywhere from 3 to 6 months worth of your living expenses in a rainy day fund, in a money market or checking account, or somewhere where it's readily accessible and earning some interest nowadays. So why might they suggest that? Well, you don't want to have to dip into your investments in the event you need money for any unforeseen emergency in the future, because timing of the market could be bad at that point in time. So this is the very first place, again, that I would suggest somebody with their hard-earned money ought to consider investing, would be to set and establish an emergency fund. The next thing that I would tell somebody to consider doing would be paying off debt. Now, Dave Ramsey fans out there, there is a lot of different conspiracies or thoughts around what debt you should be paying off first. I tend to focus on the high interest debt, the credit cards, because if you want to consider what an average credit card interest rate is nowadays, sitting around 25-30% annually, then any balances that you keep on those credit cards, you would have to invest that exact same amount of money, and it would have to earn 25 to 30% annual yield year over year to keep up with those debts that you're accruing on your credit cards. So that would actually be the second place that I would consider somebody investing their hard-earned money first prior to considering anything else. Now, there is an argument for paying off homes versus not. It really depends on your comfort level with risk and how you feel about your interest rate that you have. I tend to have a philosophy inside of my office of anybody that's paying less than 5% on their current interest rate on their mortgage ought to consider maybe hanging on to it, because you can go find a money market or a checking account that's going to earn the same interest or maybe even higher. So you've got some arbitrage there. So that would be the, again, second place to consider investing your money, would be to pay down debt. Now, before we get on to the next section, I do want to note this is going to involve some investment strategies. So please keep in mind that we always want to keep a long-term time horizon or strategy inside of these following accounts. Diversification is also the name of the game inside of investing. I would not suggest you put all of your eggs in one particular stock. I would suggest you diversifying it over many different asset classes and types depending on your comfort level with risk. Now, the first type of investment account I would consider you getting into after setting up the emergency fund and after paying down some debt will be to look at your employer-sponsored plan. Why might that be the first place? Well, they are going to offer you a match most of the time, all the time, probably inside of your employer-sponsored plan. On average, you're going to hear a 3% match. How employers normally set that up is they'll set it up to where they will match you 50 cents on the dollar from your own retirement savings. They'll do the same into your retirement account. So let's give you an example. Let's assume that I am making $100,000 per year, and I want to put away 6% of my income because I want to take full advantage of their 3% match. Well, as long as I put 6% of my income, or $500 a month, or $6,000 a year into my retirement account, my employer is also going to match half of that. They're also going to put another $3,000 in there that is mine, assuming that I stick with the company and make it through their vesting schedule. So those employer matches, sometimes there is a vesting schedule tied to them, meaning that you have to be with the employer a certain amount of time for those to be fully yours. So one thing to consider whenever looking at the employer-sponsored plan. So that would be the very first investment avenue I would consider, or third, I guess you could say, investment avenue for yourself, and again, setting up an emergency fund and paying down debt first. After you've taken advantage of the free match inside of the 401k, that's when I would tell you to look into IRAs. Specifically, the Roth IRA is my favorite. Why, you may ask? because money that you put inside of a Roth, you don't get any tax advantages today on that money. So there's no benefit for you in the moment per se. In the future, whenever you go to take that money out of that account, earnings, gains, interest, and everything else in between, all that money comes out tax-free, which is going to be a big ordeal for anybody that's wanting to retire prior to 65, prior to Medicare. There's that gap, which I've made a YouTube video on here a couple of weeks ago if you wanted to find it on the channel, discussing the advantages of IRAs and Roths and how that can directly affect your health insurance premiums in the future. So you can set yourself up with a Roth in order to have tax-free distributions to spend on your retirement income needs in the future, which again is going to help you out with your health insurance benefits if needed. If you're going to retire after the age of 65, it still is awesome in my eyes because we don't know what future tax brackets are hold. I'm pessimistic, thinking that I think the future taxes are going to be higher than today. So I would rather pay my taxes on my money now and then have it tax-free in the future is my logic. Contribution limits. I didn't hit that on the employer-sponsored plan because you're only going to want to put that match in there first. Although in the 401k, you can put away up to, if you're under the age of 50, you can put away $27,500 in the year of 2023. If you're over 50, you can actually put away $30,000 total. And then on the IRAs, whether Roth or IRA, it's a combination of the two. Collectively, your Social Security number can only put away $6,500 per year inside of a Roth or IRA. Or if you're over the age of 50, again, you can put an extra catch-up contribution, which is going to total $7,500 for the year per person. So those are the contribution limits. And again, that is the fourth place that I would suggest somebody invest their money into themselves. Next category, or the next type of account you would want to consider, which I could argue is equally as important as the Roth, is going to be a health savings account. Now, this is going to only be available to individuals who have a qualified health insurance plan. Obviously, contact your health insurance agent or whomever is managing that plan to see if you are health or HSA eligible, maybe even your tax advisor. Or you can call my office if you guys wanted me to check it out for you. I'm happy to help. But in short, it's going to be a medical expense account for you in the future. Why it's as important as the Roth is the distributions of that money for medical expenses in the future all does come out tax-free, but you also get tax advantages from putting it in there today. You get a tax deduction for every dollar you put in there. So if I put $1,000 into my health savings account, then I'm going to pay taxes on $1,000 less dollars of income that calendar year, or the calendar year that you are contributing it for, because you can contribute into health savings accounts all the way to tax deadline April 15th as well, just like IRAs. So that would be the fifth type of account that I would suggest to somebody. Oh, fun fact with this. In the event you are like, okay, Corey, I don't really need a health savings account because I don't have any medical expenses. Wonderful. That is going to be one of your biggest expenses in retirement, according to the law of large numbers and what we have on information out there. So you can use this type of account to help pay for your Medicare expenses in the future once you're 65 and older. And if you don't need this money for health-related expenses in the future, it looks and acts and feels just like a traditional IRA, or just like how a 401k would for taxation's sake. So that is, again, the fifth place I would suggest somebody invest money into themselves in this waterfall of chronological order of how you should be considering your finances. Now, lastly, once you have done all the previous things up to this point, you would then consider going back to your employer-sponsored plan to max out those contributions, because you do still get tax deferral inside of the regular 401k. I also would strongly encourage you to ask your employer if they offer a Roth option, just for the previous conversation I had on Roths and the advantages of those in the future for not only tax-free income, but maybe an adjustment on your health insurance premium too. So those are going to be the next step, or you would jump back to your employer-sponsored plan in order to save additional monies once you have maxed out the previous options mentioned above. So after you have maxed out your employer-sponsored plan, so you put away $22,500, you've put away $6,500 into your Roth IRA, you've also maxed out your health savings account, which I think is $3,700-ish in the year of 2023, you would then consider maybe brokerage accounts. Now, these are after-tax accounts, meaning there's no tax advantages like how all the other options above this one are. But there's also no retirement age restriction on these either, which is kind of nice. So brokerage accounts, you can look into annuities. You can also look into life insurance, which those are another topic for another day. But in short, you can borrow on life insurance against the death benefit before you die, tax-free, which is kind of cool. Annuities have tax deferral inside of them until you take the money out. So it kind of acts like an IRA for taxation's sake prior to taking distributions. And if you decided to buy stocks or bonds or whatever it may be, you're going to have either short-term or long-term capital gains upon the sale of that individual position or mutual fund or whatever it may be. There are some tax loss harvesting strategies that advisors like myself or accountants will work with individuals on to take losses towards the end of the year to offset their income the following year, and so on and so forth. But again, that's a rabbit hole. We won't go down that today. I'll make a separate video on that in the future if you guys would like to comment below on other topics you would like for me to discuss. So that is the next step that you would consider after going back to your previous employer-sponsored plans to max those out. You would then look at brokerage accounts. Now, the bonus tip that I had mentioned for you guys, which I think changes a lot of people's perspective on what they're doing with their lives and their investments and their financial plans, is a quote from Alex Hormozy, one of my favorite people in the world right now. Instead of investing in the S&P 500, you should be investing in the SME 500. So I know that kind of sells against myself, but in general, some of the highest leverage activities that you can invest in are going to be your own education or your own skills or your own knowledge. Because if your income goes up by 10% per year, that is going to be an order of magnitude larger than what you would expect off of an investment portfolio with stocks and bonds and everything else in between. I see myself as an advisor as more of like a piece of somebody's puzzle, not the whole picture. Your big base or your big wheel is going to be your income and where you derive it from and how you generate it. So you can always look into continuous learning. Although they are not a sponsor, Brilliant.org does offer courses to help enhance skills that would maybe get you higher employment opportunities in the future, hence make more income. Networking is always a big deal. It's served me well in my past. Getting out and meeting new people and making new relationships are going to always drive new opportunities your way. Certifications. So I've accumulated my CFP or Certified Financial Planner designation, which in my world shows a certain level of expertise in these types of topics. So upon acquiring those types of licenses and certifications and those types of things, you can then start asking for more for your services that you provide. Holistic growth. I like to think of not only your income producing skills, but also your health and your mental well-being. You are going to be better at making decisions for yourself if you are taking care of yourself physically. I'm a huge advocate of the gym. I think that's something that somebody should consider all the time, every day, because it's going to drive you endorphins and it's going to make you feel good. It's also going to make you more clear-headed. So I'm a big advocate of that. Again, I'll make another video on that topic and things that I think everybody should consider. Your return on these investments are going to be, again, orders of magnitude larger than what it would be just investing dollar cost averaging into the S&P 500. Although I do think that is a good piece of somebody's puzzle to consider. So hope that was helpful. Out to the outro.
Thank you for joining me today in the deep dive of the investment waterfall video that we have now created. If you derive value from this video, please consider leaving a thumbs up and subscribing to the channel, as we do cover other topics including financial planning, investment management, estate planning, tax planning, long-term care, annuities, life insurance, home and auto insurance, and a bunch of other topics. In the event that you know somebody who would derive value from this video, please consider sharing this video with them, as it does help promote growth within the channel. Lastly, for those of you who are looking more for an individual tailored advice, please consider contacting our office. Do a quick Google search of Stack Enterprises Virtual Financial Advisor Insurance Agency, or our contact information is in the description below. Thank you very much and have a great day.